All right, Jay, are you ready?
I'm ready.
Let's get rocking and rolling. Investors, welcome back to the channel. My name is Ari Gutman. As you know, every single week I am bringing another master of the market onto the show to talk about investing, their experiences with investing, and of course, all the successes that they've seen. Now, today, I am incredibly honored and humbled to have Mr. Jay Fairbrother on with me. He has 20 years worth of experience. He's an accountant and he has a whole heck of a lot to share with us about finance and investing. Without further ado, investors, let's get right to it here with Jay. Jay, the very first question I want to ask you, and I'm just going to go right out of the chute here. What is the total value right now of your portfolio?
Um, right now, if we include retirement accounts and all that, probably around 750,000.
$750,000.
Yeah.
That's about 20 years worth of investing, correct?
Yes. Yeah.
Give or take 20 years worth of investing. So, all right, $750,000. That is a whole heck of a lot. And I want to ask you now, just what is really the Jay Fairbrother story? How'd you get started and how'd you get to acquiring 750,000 in the account?
Well, I got started. I've actually told this story on my channel in a video. I got started back when I was in high school, which is around the time of like the dot-com bubble and all that, if I'm not making myself sound too old. Um, I don't know how I did it, but I convinced my dad to let me take everything I had saved up from summer jobs and all that and start investing
Heck
it.
yeah.
So he he opened up an online brokerage account for me and kind of just let me go for it.
Wow.
Uh,
Wow, wow, wow. I got to ask
I
before we even go even further, what type of summer jobs were you doing? I have a fair amount of, those in their early 20s, some in their teens. We have a whole heck of, a lot of viewers who are actually approaching retirement. But for those younger viewers who are out there looking to make some money right now, what were some of the jobs, the odds and end jobs that you had and that you were working that paid well?
well, none of them paid well, but yeah, I spent a lot of time. I umpired little league baseball games. Once I got like too old to play, I started like umpiring some of those games, making some cash. That was easy and fun. Then my main job throughout high school is I worked at a grocery store, stocking shelves, being the cashier, that sort of thing.
There we go.
So
Blood, sweat, and tears.
and thankfully, I've always been a good saver. So and everything I was earning, I was just stocking away, saving. So you know,
Sure. I
kind of
feel like
started strong.
it was almost in the blood and in sight for you to become an accountant, like always more of a risk adverse job. And you right down that path from saving
Yeah, well, I
diligently
mean,
to an
the
accountant.
funny thing is, I never set out to be an accountant. I didn't know what I wanted to do in college, and I always had the interest in finance and the markets. So I'm like, well, I'll major in finance. At least then, no matter what I do, at least then I'll have the background where I can take care of my money and probably be somewhat well off,
Sure.
no matter what I'm making. So
Sure.
yeah, I majored in finance in college, then got out and kind of backed my way into various accounting jobs, and here I am.
All right. So let's back up really quickly. So you went to college, you had a lump sum of cash at 18, 19 years old or so. You had that lump sum. How much was it that you ultimately amassed at 18, 19 years old?
Well, there were some big bumps in the road. That's the video I referenced that I made about this story. Is I took that initial savings I had, put it all into this stock that my dad heard from a guy he worked with that was a good stock to put your money into. And this being the tech bubble back then, like from the minute I invested, it skyrocketed. So I think I put about 5 grand in initially, which is a lot when you're 17 years old.
Sure.
Uh, it at least doubled over the span of a couple months. And I'm
Wow.
like, well, this is crazy. Like I've made so much money. So I sold the stock. I'm like, all right, I'm out. I got my money. And
Do
then
you
I
recall
remember
which
my
stock
dad
it
coming.
was?
Uh, it was Agilent Technologies.
Agilent Technologies. I'm not even
They
familiar. Are
had
they
just
still
spun
around?
off from HP at the time. They're still around, yeah. But you know, actually, can you hear that in the background? I'm sorry, I forgot to turn that off. But So yeah, I bought that stock. It doubled. I like, okay, I made my money. I'm out. I sold it. My dad came home from work. I told him, like, I sold the stock. I made all this money. And his reaction was like, you did what? Why would you do that? So then, I'm 17 and naive. I'm like, oh no, I made a mistake. The next day I bought back in.
Oh
And
no,
of course, from there on down, it
plummeted.
tanked. And I ended up losing just about everything. So
Oh,
that was a harsh lesson right off the bat that I got. And yeah, from then on, I never really had a lot of money, as most people don't in college and stuff like that. But I always tried to invest what I could, and always
sure.
had some sort of portfolio going. But obviously, it wasn't really until I got out of college and started working for real that started building.
Sure. Sure. Okay. So you made a ton of money. You lost a ton of money right out of the bat.
Yeah.
I'll honestly share that, when I first got started investing, first and foremost in high school, I had an absolute fear of putting money even into the money market and just getting invested into indexes and ETFs. Honestly, it's like sometimes you watch the stock market, it's going up, it's down, it's left, it's right, it's anywhere in the middle. And
Yeah.
there could be a lot of fear there. And, I ended up getting started really in college then with VTI, Vanguard Total Stock Market Index Fund.
One of
I
my
didn't put
favorites.
everything in, but I started kind of dollar cost averaging my way in and, flirting really with investing strategies to find the one that would best suit me. And I
Yeah.
feel like I built this really nice foundation then with VTI. And it took me then some time to actually then invest into individual stocks. How soon after, when you lost the money, because I know there's probably a lot of fear there, how soon after did you then get back into the market, get back on the horse, and what did you get invested into after that? Were you playing it safer at that point, or risk
No.
growth stocks? Like what were you
No.
doing way back in the day?
I don't remember exactly how long it took me to get back in. I remember when I was in college, I invested in a handful. I invested in I, maybe some other things. I remember holding Honda, the car company,
Sure.
Pepsi, and then Sirius and XM Radio, like back when they were first on the scene.
Sure.
And I remember holding those four stocks through college. Uh, they actually did pretty well. But then I kind of had the opposite journey of you, where I started out buying all these random individual stocks, really not knowing what I was doing, like most people do.
Sure.
You're buying things. Oh, I like that company. Someone told me that was good, so that's why you're buying them. And it wasn't until later on where I kind of stopped buying individual stocks, and now I've gone the index fund route, the VTIs and stuff like that.
Sure. Did you see a lot of success investing into those individual stocks at first?
Uh, yeah, I mean, I got to say, other than that first wild ride I took, I did pretty good because Honda, Pepsi, like solid company. I still own Pepsi today. Actually, I've held that forever.
Sure.
Um, and I got luck. I mean, I got lucky with Sirius and XM. There was kind of the thing where like I was, big into music, like going to concerts, all that kind of stuff. And I'm like, so I knew about the companies. I'm like, wow, they're like targeted for someone who like me. Like, I don't like what's on the radio, but I can go listen to whatever I want there. That's gonna be awesome. So that's the reason I bought those. And yeah, they did well. Then they eventually merged, and I forget when I sold them, but made some money.
Sure. No, look, it's again, like I almost wish I can go back in time and be a little bit more risky because with time, right, being young, you have time. And that's, first of all, the
Yeah.
most important thing as an investor. But looking back, like one of my biggest positions today is Apple. I'm a dividend investor. It does pay a
Hmm.
little dividend, but it's also this massive growth player. I started getting invested into Apple, I want to say even after I got out of college. I was so VTI focused and let me just
Yeah.
all index, that's it. And then I finally started to invest into Apple and I saw some growth. But looking back, I wish I got a little bit more risky. I don't even know if you want to call Apple risky. Like I feel like it's the farthest thing from a risky stock in terms of risk in tech. But nonetheless, right, like I think as investors, we can sometimes lose sight of how much time we have and how much risk we can actually
Yeah.
tolerate at certain ages, which begs the question that I want to ask you, looking back. So at that point in time, you had X amount and it's now at 750,000.
Hmm.
I want to ask you, looking back in this 20-year or so history of yours as an investor, what was one of the worst mistakes you've ever made? And then I'll double back that question with the best one that you've made, the best choice you've made as an investor. That maybe it was a strategy change. Like, did you go from growth to dividend investing? Did you go from growth to ETFs? What would you say would be your biggest success and biggest I want to say mishap there as an
Well,
investor?
I mean, the biggest mishap I think we already covered. I have, well, I mean, I probably lost more money in dollar value with some things I've dabbled around since then, but as a percentage of my portfolio or my net worth, like that was the biggest, and that was the harshest lesson, losing right off the bat. I guess the biggest success I've had, like, I mean, buying Apple, like you said, was a good one. I got to say, my time, I mean, not to sound arrogant, but my timing in general has been pretty good. I've always been good about not getting scared by the news and things like that. So, I started investing a lot. Like, I got out of college and started investing right, during the Great Recession. So, like, I bought a lot of my stocks and index funds then, which obviously, I mean, you couldn't miss.
Yeah.
But I bought Apple. I forget. I bought it in 2011 or 13 or something like that, where
Sure.
there was a lot of negative news surrounding Apple for whatever reason at that. Like, they've lost their touch or something like that. And I'm like, that doesn't make any sense. Like, Apple's a great company. And I think at that point they had just started paying a dividend. So my view on it was, well, all right, even if they're not going to be this mega growth stock anymore, they're sitting on this giant hoard of cash. They just started paying a dividend. They got the potential to be, the next great dividend stock, no matter what happens. So
Sure.
I bought it kind of for those reasons. And it's been Apple ever since. It's been great. So,
It's honestly, I think one of the best, performing stocks in my portfolio for sure.
oh,
Uh,
yeah.
Now, look, this is something interesting that you just mentioned, and I hear it so often because I'm also a huge believer in macros matter in terms
Mm-hmm.
of like understanding your macros when it comes to the stock market, only so that you can try your odds at then picking the right sectors or the right stocks at specific times and using that to your advantage. So not timing the market per se,
Mm-hmm.
knowing what's going on to then have time in the right places in the market. And I
Yeah.
love that you just alluded to, right? Like you've always seemed to have some pretty good timing. I want to ask you now, when it comes to your timing, when it comes to your strategy, what have you been doing? Do you focus on macros?
I really don't. I try to ignore as much of the noise as possible. My strategy is it's actually the title of a great book. I can't think of the author's name right now, but just keep buying.
Love
if
it.
I can condense my strategy on anything, it's that. It's at this point I have my core investments. I know what I'm investing in. It's just about continually buying, continually adding money, and getting it to grow.
Sure. I want to double back that. Do you have an investment hero? Like you got the book, Don't Stop Buying. Do you have an investment hero that was also alongside maybe the book when you started investing to understand like, okay, here's what, my hero, whether it's Warren Buffett, for me, it's Buffett and Ackman. I use a lot of their investing strategies combined. Who would you say would be your go-to investment hero?
I mean, I gotta say Buffett, just
Sure.
because the the way he takes such complex things and makes them so simple for people like you and me to understand, like, and like, he lays it out. Just do this. Like, don't try to be a hero. Don't try to emulate like what he's doing,
Sure.
because we don't have the time to read all the reports like he does. We don't have the talent, you know.
Sure.
So
Sure.
it's kind of like I enjoy his do what I say, not what I do mentality.
It's so simple. Like every time I watch Buffett or I listen to Buffett, what's crazy to me is he hasn't said anything new since,
Mm-hmm.
I've been listening to him. And I feel like investing really is that simple. To your point with your strategy, right? Like, don't stop buying, just keep buying.
Yeah.
I think it's even for those investors out there, Jay has, of course, his own YouTube channel. If you go to Jay's channel, the link there will be in my description. But go to Jay's channel and check out his actual homepage on YouTube, and you'll see there that he has his tagline. It is literally buy, hold, right? Like, do not sell.
Buy, hold, and repeat.
Yeah. Buy, hold, repeat, don't sell. And I love the mentality because that's how I invest. That's how I've been investing. I'm just going to keep buying quality stocks and hold. Now, for me, it's always come down to three pieces of criteria. It's come down to companies that have great management teams, like management teams I feel like I can either work alongside with, or, right, if they're running the company, I am agreeing with a lot of maybe 90% of what they're doing and how they're running the company. Two, I always look for very strong brand names. And last but not least, of course, that balance sheet clean. I want it like squeaky clean. So therefore, I never really have to worry. Yeah. Do you have, for this buy and hold repeat strategy you have going on, criteria for you when you look at stocks? What would you share with us, whether it's the younger investors, the beginner investors, the more experienced investors, especially from the eyes of an accountant? Like, what types of tips, tricks, and advice would you give to us as we're evaluating stocks?
Well, my main advice is keep it simple. I mean, like you were alluding to, probably over 95% of my investments are in, index funds and different ETFs. Like, my individual stock buying at this point is kind of just, just for fun, just to scratch that itch a little bit. And I think that's a mistake a lot of people make when they get into investing. You start investing, you think, oh, well, I got to be on the lookout for the next Apple or the next Tesla or, things like that. You really don't. Like, it doesn't have to be complex. It's not supposed to be complex if you're doing it right, in my belief. But as far as picking companies, yeah, I mean, the balance sheet is the top thing. I mean, if you're not reading a balance sheet, then like you shouldn't be buying an individual stock. Make sure the company doesn't have a lot of debt. Make sure revenue is growing, things like that. But the number one thing I look at in individual stocks at this point is just the quality of the brand.
Sure.
The individual stocks I'm holding are all like mega household names. I got Apple, Visa, MasterCard, Costco, things like that. Like, all companies I can see, like, they kind of like rule their market and they're not going anywhere, so they're relatively safe. Yeah.
Sure. Now, so this next question here, because this is actually one I've been asking everybody that's been on the Masters of the Market Talk. How many stocks would you say is ideal to have in your portfolio? And you can talk about the indexes and ETFs you have in there, but I'm curious because I've always heard, right, a variety of different answers. And I even see, through in my comments on different videos, right, I hold X amount of stocks, I hold Y, this is the perfect number. And I'll be honest in sharing that I think one of my regrets or mistakes as an investor was actually it happened during 2020. So, I got out of college, I was heavily invested in VTI, slowly started, buying some Apple, into some other bigger names as well, the Procter & Gamble's, Johnson & Johnson's, very, a few years later, 3-4 years later, 2020 hits, and it was like a buying bonanza for me. Like, I was like, yeah, I saw some YouTubers out there like Andre Jick and Jason Fieber, and they always talk, just buy, right? Buy good stocks, have them all in your portfolio. And I think Andre Jick at that point in time, he would always show his portfolio, and it would be like dozens and dozens of stocks.
Yeah.
Jason Fieber is like, I got 100 plus, right? Like 100 plus holdings in my portfolio. So I go, you know what? I'm going to build a fortress of a portfolio and just buy everything I can. And looking back, that has been, one of the worst mistakes. My portfolio went from like 8 holdings of like building more quality positions to 46 to 50 holdings at that point in time. Now, fast forward, here I am today. I'm actually trimming. I've been trimming for the last like 2-3 years, right? Trimming out when I'm seeing the profit. and then reallocating that capital. But long story short here, huge regret for me, because now using that Bill Ackman approach where it's like, find the best 10 to 12 high quality companies, invest into them like there's no tomorrow, buy, hold, repeat.
There you go.
How many holdings would you say someone should have in their portfolio? Do you have any stance on that?
I don't think there's a perfect number of stocks or whatever to hold. My strategy is, the foundation, like the core of my portfolio is, 3 to 4 solid index funds. That's where most of my money goes. And then from there, you got that solid fortress, as you were saying, and then from there you can add on if you want to go dividends or growth or whatever you want to do from there, but keep that core. I think if we're talking individual stocks, I mean, the ideal number to have is the number you can keep track of. Because I think buying a stock isn't just like, oh, I bought a stock and now I'm done. You got to keep up on how that company is doing. They're like, I back in the day, I used to own BP in my Roth IRA, and they had that giant oil spill back 10 years ago or whatever. Like, things happen in these companies. You gotta stay on top of what's going on or what's going on their balance sheet. Where if you can't track, if you have 50 companies, there's no way what's going on with all of those. And whenever you get to that point, I think that's when you say that's too many.
That has been, in all fair disclosure, I think the best answer that anybody has ever shared on the channel.
Yeah, right.
Like, do whatever, like 70's fine, 50, I have this amount. But to actually put this into perspective for everyone, look at stocks like running a business. Like, you are becoming a part of that business. I always like to look at it as if like, okay, I'm going to invest in a company, and my number one goal is to sit next to the CEO as if I'm like right there with them running the business. So understand the business, know what's going on, keep updated with it. And therefore, you're right. You can't necessarily understand 50 different businesses, what's going on with them 100% of the time. Jay, how many positions, individual stocks, are in your portfolio at this moment?
At this moment, too many, if I'm full disclosure, because I have a lot of holdovers from earlier on in my investing career that I'm just still holding on to, and I'm slowly trying to transition over to more index funds. But there's only probably 4 or 5 I would consider buying more of right now, and those are the the handful I mentioned earlier. But
sure,
that's what you were just talking about, is probably one of my favorite lessons from Buffett, like we mentioned earlier, is when you're buying a stock, you're not buying you're not buying a number that goes up and down. You're buying a part of a company.
Yeah.
And you got to understand what you're buying.
I think
it baffles me. Like, we all work so hard for our money, and then you see people just like throwing $1,000 at this or that just because they read a Reddit post or something.
It's like it breaks my heart. Like, honestly, I have worked with, I'm not an accountant, right? Like, I'm not a financial advisor. I really love, sitting with friends and family, and anybody really who comes my way, maybe a friend of a friend. They're trying to either get out of debt, and they want a strategy, or they want to understand investing a little bit better. I always take the time out of my day to sit with them, and what I always hear from them is, okay, so am I ready to get invested in the market? And then you start to ask some questions, right, and like poke around on their mindset. And it's like, please don't start investing just yet. Like, hold tight, because I think it's so easy to like this get rich by Tuesday mindset that I feel like so many investors have. It is killing more wealth opportunities, I think, than anything else. The instantaneous gratification, like, I need to get rich by Tuesday. Give me this meme stock, give me Bitcoin. And I'm like, what happened to investing? Like, investing.
I know you hear people call themselves a long-term investor now because they held something for 6 months. But I've had that conversation you just talked about with so many friends and family members. Like, and that goes back to what I talked about earlier, is people think that investing means they got to find like this diamond in the rough stock that's gonna make them rich by next month. And It's not how it works.
No,
Not how it should work.
you're going to own the business. Like, I think
Yeah.
Warren Buffett used an analogy. I forgot how many years ago, but there was a recording of him sharing about like, and he was in a lecture hall. I know this. The video is on YouTube somewhere out there, but he's talking about when you approach investing, start to look at investing as if you're a farmer and you're going to look at a piece of farmland. And before you even go to that farmland, you have to understand farming. And you have to understand, right, the crop that you're going to grow. You
Yeah.
have to know the crop very well, and then you go to the farmland, and then you buy the land. And then most importantly, if the farmland isn't producing an ROI by next season, that's because you have to work the land. And then
Yeah.
you have to hold on to the farmland. And most likely that farmer is going to hand that farmland down generationally, right, to his son or daughter or whoever else, is coming down the way. And I just think today, right, it's like the minute you said, I've had so many of those conversations when you hold that people are like, I'm a long-term investor for like 6 months.
Yeah.
I'm like, no, that is not a long-term investor. This, it's like I said, it's killing so many wealth opportunities. I want to ask you now from like your professional perspective, from your experience, how long? So of course, you have different investments, which I want to talk about your ETFs and indexes in a hot second, but you also have, it sounds like a plethora of individual stocks. How long should someone hold the stock until you know it's time to sell it? Like what, because the buy, hold, and repeat is incredible for solid companies. But what happens in like, I don't know, a Kodak situation? Like, how do you know when to sell? Or even AT&T, that's the hot one right now.
Yeah. Yeah. I guess like my default answer to that is always, you obviously had a reason for buying whatever stock it was at the point you bought it. Like when that changes, if something changes about the company, or like you wouldn't buy the stock today for the reasons you did then it might be time to sell. Or, if maybe the stock has, like Nvidia recently has gone up, hundreds of percent in the past month, maybe it's a time, cut back a little bit, take some money. But
Sure.
Yeah, I think the main answer to that is when the reasons you bought the stock have changed. Yeah, that's as simply as I can probably put it.
Yeah, there's simple answers, but you know what? Like of course they make sense. They're simple, but they're also the investment advice, if you will, right? That you can actually share with someone. They can take that and run with it, because a lot of the times, again, like it's like your other answer. I was like, that was the best answer I've ever heard, right? Like hold as many positions as you can keep accountable in your portfolio. Yeah. This one, right? I feel like everybody has like this magic, like, oh, I'm going to sell it if it crosses this right threshold or this. But I think you're right. Again, right? Like keeping the advice simple, as clear and clean and simple as it can be. And when you're investing, keep it simple. Like the ABCs, like don't complicate anything in this process.
Yeah. And I mean, there's nothing wrong with that either. If you buy a stock and say, I'm going to hold it. I bought it at $40. I want to hold it till it hits 50, and it hits 50, sell it. No problem with that,
Yeah.
And with like when I was buying a lot more dividend stocks in the past, like, if they stopped raising their dividend or they cut their dividend, that was the sign you're gone. That's the reason I'm holding you.
So one of the reasons, not the reason I found you on YouTube, as I was going through and searching for ETF videos, right? Different. Yes. One video you recently posted was on SCHD. I think you had like 2 or 3 of them recent posts. Highly recommending everybody go check out those videos. Very informative, very insightful. But it led me to Jay, and I want to talk now about how, right, like what type of investor you consider yourself right now. Are you an ETF investor? Would you consider yourself a passive income investor, solely dividends, growth? Like, how would you classify yourself?
I guess I would classify myself as mainly I lean towards the bogglehead style, the main 3-4 ETFs. And then to the side of that, I'm still a dividend investor. I have a separate portfolio. I'm trying to build up for like a passive income stream, and that's all like dividend ETFs. But the majority of my money is in index funds like VTI and things like that. So
Okay.
that's the core of it, and then I do some dividend investing off to the side for an income stream.
Sure, sure. No, a boglehead investor is always a very simple investor. All right,
Yeah.
so now that we have that, okay, he's a boglehead investor, really, which means buy, hold, repeat, and find the quality, buy and hold. I want to now double dip into SCHD. What's been prompting you rather recently to talk so much about SCHD? What's the hype about? How do you feel about SCHD? Is it in your portfolio?
It's in my portfolio. It's my largest dividend holding right now. Yeah.
What how many shares of SCHD do you have now, and how much is it bringing in dividend income?
I don't know exactly because I have it in a couple different accounts. I have some in like my Roth IRA. I have some in a taxable account. I think between the two, I have about 10 grand worth of SCHD.
Substantial amount.
Yeah. So it's my favorite dividend ETF. I like it because I think it's got the strictest screening criteria of the stocks it holds out of at least any dividend ETFs I'm currently aware of. Maybe there's a better one out there. I think, the reason I made so many videos about it is because it seems to be all anyone can talk about in the dividend community. I think everyone fell in love with it because it performed so well over the past 5 years or so, where you're getting the dividends from this dividend ETF, but it was also outperforming the S&P 500 for a while. So I think a lot of people just didn't look past that and piled in, and I think that's the wrong way to go about it. But just
you do plan to hold, like buy hold, right? Like that's it. You have
I have no plans to sell it. So
sure.
I know it's going through a little rough patch ever since they every year it changes some of the stocks it holds, and it's been going down this year, but
you know what, it makes
I believe in the strategy still.
It makes sense. Like I again, that's why I say like macros matter, because we get again so worried about, oh my God, this stock is going down, this ETF is going down, sell out of it, get out. But when you take that step back and you breathe and say, okay, like what's happening economically right now that would make SCHD come down, right? Or X stock or Y stock come down.
Yep.
And when you know those macros, it's not that you're going to try to time the market any which way. It's really for your emotional standpoint to be like, no, wait, this is still a good ETF. Yeah. It's still going to be a great ETF to hold for the next 2, 5, 10 years out. Likely it will continue to rise. And speaking of economics, I've been talking a lot about with other YouTubers out there, financial YouTubers. Okay, like in the last couple of weeks, we've had a lot of news come out. We've had inflation come down from 4% to 3%. But we've also had Powell in the gang. I like to call Powell in the gang, the Federal Reserve coming out very hawkishly, rather recently, that I think has spooked a lot of investors. But we also have, this is right, the Goldilocks situation that's happening that I don't think anyone thought would happen. Inflation coming down, robust labor market. Can we make a soft landing? And I think this whole scenario we're in right now, even tech is like soaring.
Yeah.
But I'm worried for the next 3 to 6 months, basically the remainder of the year, because what I think, and I'd love to know your opinion on this, what I think is we're going to see a lot of pressurized businesses as well as consumers, even though inflation has come down, and we're going to get that pressure from interest rates. And I think there's either one going to be a crazy, amazing buying opportunity that we shouldn't be waiting for, right? Like don't time the market, but know that it may be there to have at least some dry powder on the side.
Absolutely.
But also at the same token here, it's like in the event that doesn't happen, continue to find the gold finds now in the market. I'm curious to know, Jay, what you think about the next, 3-6 months. How are you investing? How do you plan to change strategy? Probably not, or buy, hold, repeat, but do you plan to change strategy? Do you are you going to look into certain stocks and favor them more than others? how do you like, what's on the horizon here for 2023, the remainder of it?
Well, I'm not going to change my strategy. You know, I guess the only way I change things is, when things are like real rough out there, like uh, most of last year, I'll probably buy more than I usually would if I can, if I have the cash to do so. Because you recognize the good buying opportunities when they're there. But yeah, I mean, I know if you're watch a lot of finance YouTube channels and things like that, like it has been, everyone at least was, all over Powell and the Fed and all this kind of stuff. Maybe it's just easy clicks, but I got to say, I'm amazed. Like to this point, hopefully, hopefully we continue this trend. It seems like they've done a great job, and it looks like they're going to get the soft landing. I
Yeah.
mean, I'm not in the business of making predictions because yeah, I mean,
No
I
Michael
know
Burry
enough. I
approach.
know enough about economics to know I don't know anything. So
Hey, I mean, Peter Lynch said it best. He said, if you spend, I think it was, he used 14 minutes. If you spend 14 minutes a year studying economics, you've wasted 12 minutes. There's a Peter
yeah,
Lynch quote. It's one of my favorites. I love studying economics solely because I just love to understand, like, okay, what may connect to what. And, at the end of the day, Peter Lynch did study a lot of economics and bring it into his investing career. Again, only for the same reasons of just like understanding where to invest during certain economic downfalls if they come
yeah.
up.
Oh, I mean, I find it fascinating. It's so interesting. But yeah, I couldn't tell you what they should do or what they shouldn't do, and I'm not going to get into that because I know I don't know anything. But I think, I mean, inflation seems to be on a downward trend now. I mean, it's been a handful of months in a row now where it seems to be steadily falling.
Sure.
I don't know at what point it'll get where they'll say, okay, we're interest rates are good. We're either going to freeze it or maybe it's time to start lowering things. But I don't think we're going to see these interest rates like they are, long term.
Yeah. No, it's interesting because I'm trying my best to follow the Fed, and just what I've realized, right, over time of listening into the Fed, the FOMC meeting minutes, they really give us exactly what they're going to do before they do it. And
Yeah,
they always follow through on it. And now I'm interested because we're coming up to the next FOMC meeting. And from the last one, they've said, okay, 2 more interest rate hikes likely. But that was before inflation, the newest inflationary report came out.
yeah.
And that was also before literally this past week with earnings going crazy and big banks actually performing very well. And so it's going to be, I think, very interesting this next FOMC meeting, whether they raise hikes, raise rates one more time, hike them one more time, what they do. But again, I'm thinking about the future here in terms of like, will there be another economic downfall of some sort, of another 10 to 20? I would love for it, only so that I can invest into some of my quality positions. And with
there,
that,
there will be. We just don't know when. I mean, it's just part of the cycle. It's going to come at some point, whether that's 6 months from now or 6 years from now. We can't predict, but
let's say it came next week, this 10 to 20% economic downfall. What 3 stocks do you have in mind that you would pick up? You have dry powder now on the side, I'm assuming. At least some capital ready to
not enough if that happens soon. I'd be mad I don't have enough money to take advantage of that. Yeah, I guess. Well, I mean, I guess first of all, it would matter what caused that downfall. If it was any industry or something, like if banks collapsed again, I wouldn't be buying Bank of America. But I think, I mean, my 3 go-to stocks, like for the past 5-10 years, have been Visa, Apple, and then probably I really like Costco lately. I
Yeah.
just probably those 3. Those are my 3 go-tos of individual companies I really like.
So
And
Apple, Visa, Costco.
yeah, I just think they dominate their markets, and that's not going to change if the market drops 20%.
So no one be surprised if we see Jay as the largest shareholder of either Apple, Costco, or Visa coming up.
Oh, I would
um,
love to have enough money to make that happen.
Slowly but surely. I mean, look, you're almost a million. It's really not too far
Yeah.
out. I want to know, based on the 750,000, right, amassing in your portfolio, all this experience, 20 years of experience investing, and it sounds really all very simple, but
Mhm.
what has been, do you think, like the biggest factor in your success as an investor?
I'd say the biggest factor in my success is I don't get emotional over it. Um, if stocks are soaring like they were, in 2020, like the Wall Street bets craze and everyone's going crazy, like everything's popping off, like I'm able to tune that out, and like things fall 20-30%, everyone's panicking about a recession, like that's not going to bother me either. Like I'm not going to get all hyped up either way and make any decisions based on those emotions. And I think that's probably my greatest asset when it comes to investing.
Sure. Is there a way that we as investors can train ourselves, do you think, like to better handle our emotions during these economic downturns? When you're with clients,
uh,
like do you share any advice and like, okay, the market may get volatile, just duct tape yourself to the seat, don't touch the clicker to trade out of stocks. Like,
I mean, I don't know how to tell anyone else to develop that skill. I know I I played a lot of online poker in college, and you do enough of that, and you learn, don't let the money swings affect you too much.
sure.
So maybe not the best life example there, but
No, look, it's real. Like every answer you've given, again, very simple, but like a real applicable approach to investing. And
yeah,
even right, like don't panic. Just don't, no matter what you
yeah,
do, don't panic. If you're buying, don't panic. If you're selling, don't panic. Invest into a stock because you have strong, reason to believe that that's a number one, a good company to invest in. Number two, it's all over time going to go up. Then you can actually buy and hold. But
yeah,
don't
and
panic.
that's something that really got ingrained into me. I worked at one of the too big to fail banks during the Great Recession.
Wow.
And I remember, like, I used to joke, like, they hired me, the stock price was $75. They let me go, it was 75 cents. But, I remember when all that craziness was going on, stocks were dropping every day. This woman sat next to me. She was in her 50s or something like that. I remember one day she just like had enough, couldn't take it, like called up her broker, like liquidated everything she had. And I just remember seeing, like, even back then, I'm like, oh, that's a huge
Wow.
mistake. Like, oh,
Wow.
don't do that. Like, it's,
Well, you had that experience from back in college. Right?
yeah,
Let everything
like,
done.
I'm like, yeah, it's, I don't know, a lot of little examples like that I've just seen over the course of the years that, I've been through a couple of recessions now, and, they don't last
Sure.
forever.
Sure. No, look, that's another key point is nothing lasts forever, right? You're going to
Yeah.
have your economic downturns, volatility. You're going to see everything as an investor, but don't quit investing. Like, don't lose the time in the market just because it's fear and it's
Yep.
emotional. I like to call it emotional investing, right? But
Yeah.
emotionally investing is like the worst thing you could do. I want to ask you a bit of a deeper question here because you said you worked at one of the two big banks there that went under. What
Well,
was
not
it
went
like?
under. They're still around. They were just one of the ones that got bailed out.
All right, one of the buildings. So, but the stock from 75 to 75 cents, something of that sort.
Yep.
What was it like? How were you feeling when you were watching that stock plummet? Like, did depression come over you, or like, feel free to go as deep as possible here.
I mean, it was just crazy. I mean, I guess at that point I didn't have anything to compare it to. It was my first like real job out of college.
Sure.
So, but it
Welcome
was,
to the workforce.
yeah, yeah, really. Well, welcome to your career. But I mean, the stock price started dropping. No one, when you're working there, no one's paying attention to that, like at first. But then, oh, you hear, oh, they laid some people off in this office or that office. And, then when things really started getting bad, it was like everyone's just showing up to work every day. Like, oh, is this the day we all get let go? Like, it was, I mean, it was bad. There's such like a black cloud over everything and everyone. Like, we're all just like counting how many days do we have left here before we're the ones getting cut today. And like, you know, a lot of people had their 401ks or whatever type of company stock. Like, they're like, you know, they were obviously in a pretty bad place, like watching the markets every day. It was really ugly and really depressing to go to work every day.
Sure. No, I can't even imagine. You know,
Yeah.
I've only heard the stories and there's no words. And what that time was like. And of course, I wasn't investing really at that point in time. I do wish I was, right? To be able to scour the markets and looking for those opportunities. But look, there's always, to this point here, opportunity when there's mayhem. No matter what, right? Like, no matter what you're doing in life, I feel like there's always opportunity out there. You just have to find it. No matter what's happening, find the opportunity. Coming back into investing, enough life advice, right? Back into investing. I want to know, again, like I'm impressed by the 750,000. And you're doing it through very simple means, which again completely aligns with, you know, my channel, with investing, with the investors who watch, you know, my videos, and I'm sure all the viewers out there watching your videos. What would you say, you know, if you had to give just one piece of advice here, right, for beginner investors, experienced investors, someone who is perhaps just about to get invested into the market or has fear, like this general blanket advice to that person from an investor with $750,000 in his brokerage account and growing almost at $1 million, what would you share with that individual in terms of advice or suggestions?
Well, if you haven't started yet, start. I mean, that's really all there is to it. Yep, it's the generic advice everyone spouts out, but timing the market beats timing the market. So the quicker you can get started and start building your portfolio, like the better off you'll be. I mean, it's really amazing how you start with such, you know, everyone starts with a small amount.
Sure.
But then, like, you know, you just keep adding money, you keep buying stuff, like, you know, you're living your life, you're not paying too much attention to it. Then one day, like, you check your brokerage account, like, wow, that's a lot of money. Like, it, you know, that's just kind of how it happens, especially if you're investing like in a 401k at your job or anything like that. Like that, you know, it's out of sight, out of mind. It's easy to put on autopilot and it really adds up fast.
Sure. No, I love it. I love it. It's so true. I mean, when I first started investing, and I think back, you know, I went down the path of a dividend investor. So for me, it was like there were, you know, months where like I'm calculating my dividend income, totaling it out for the remainder for the last day of the month. And I'm like, wow, I only made like $1.50 on, you know, X stock, like whoop-de-doo, right? But fast forward, after years of just reinvesting dividends, reinvesting into that company, you know, throwing money into it. I mean, my dividend portfolio and dividend income for that matter has grown just tremendously. And it's keeping it that simple. I mean, don't time the market, just continue to dollar cost average and build these high quality positions. I want to close out here with one final question. It's been a question I've been asking everybody on the show, and I've enjoyed everybody's answer. For you, I almost feel like I have the answer. It's going to be one of the stocks, but we're going to ask it anyways. Jay, I'm giving you $10,000 right now. What is the one individual stock that you would invest into?
Apple.
There it is.
I guess I'll give you my I'll give you my reason, because I wanted to touch on this, but we didn't get to it. Like, when people talk a lot about Warren Buffett and how much he brings in dividends, he invests in Coke and all this, and I think dividend investors, especially now, gravitate towards those old dividend companies, your Johnson and Johnson, your 3M, your Cokes. I think you should, like, when Warren Buffett bought Coke, it wasn't that company. It still had a lot of growth ahead of it too. So I say look for the companies like your Apples, or I think even Microsoft pays a dividend now. You're like the ones that are going to become those companies in the future. I think if That way you get the best of both worlds. You get the growing dividend, you get the growing stock, and then, 20 years from now, you're rich.
I love it. I love it. It's that simple. 20 years from now, you're rich.
No promises, but
No, look, it's so true. We don't think about that. We think even today with dividend investors, I think it's like, okay, and I've seen this a lot. Friends on YouTube, who are making videos, they say these are the dividend stocks that you got to own, you got to buy them now. I'm always hesitant to share some of the same stocks that are shared out there because Coca-Cola is one that's thrown around all day long. And I'm not saying it's not a great dividend stock. I own the stock myself, but it's not necessarily going to deliver through on the growth that I think a lot of us dividend investors are after. I think Coca-Cola gets a lot of this hype because, it's like the Buffett proof stock. Buffett's got a vast majority of it. And it's a quality company, which makes it a great dividend company stock to own. But if you're looking for that dividend growth, you have to buy Apple at the right price. And sometimes I see these videos out there with YouTubers saying, these are the 5 stocks you have to own for 2023. And then I look right at the valuation for Coca-Cola and I'm like, what? Like, it's not a right buy right now. Like you're essentially sharing with people to buy it now for what?
Yeah, I think if you're looking for dividend stocks, look for the stocks that are growing their dividend the fastest, not the ones that have been already paying it for 50 years. At least that's my strategy when it comes to dividends, at least. And I think if you're on the younger side of things, if you're in your 20s or 30s, I think that's the way you got to go. Don't AT&T isn't going to make you rich at this point.
Hang up the phone on AT&T. No, it's so true though. It's like at the end of the day, I think what matters here is, and I've heard this from someone else, and a fellow YouTuber, what matters is your scoreboard. Your scoreboard is the value of your brokerage account. And if you're doing well with, growth investing, keep at it. If you're doing well with dividend investing, keep at it. Growth is growth over time. But if you are looking to capitalize on more growth, more profits, then look for those stocks that have that room to actually grow instead of just doubling down on the Coca-Cola because everybody, and their mother is buying Coca-Cola.
I'm glad you said that too. I think a lot of people right now they treat investing as too much of a competition. Oh, dividend stocks are better than growth stocks. No, growth stocks are better than dividend stocks. Oh yeah, well, selling options is better. Like, it doesn't matter what the quote unquote best strategy is, or what strategy might get you 1% more per year than the other one. It's about what you can stick to, and what's going to help you get to whatever goal you have, not what's quote unquote the best. So just
100%.
worry about yourself when it comes to investing, not anyone else.
What you can stick to, your timeline as an investor. I mean, these are all crucial as from an investor, from 2 investors to all investors out there, right? Like, stick to what is going to actually make you feel comfortable as an investor to keep your skin in the game. And with that, I mean, look, we've heard it here first from Jay Fairbrother, $750,000 within his brokerage account. And for a dividend investing YouTube channel here, Jay is not necessarily the dividend investor out there. Now, the reason I have him on here is because he has been doing an absolute standout job in terms of profiting in the stock market, keeping that skin in the game. And of course, you see firsthand here, $750,000 within his account. Now, again, the channel of his will be in my description. Please go check it out. Investors, ladies and gentlemen, Jay Fairbrother, thank you so much for joining me on a Masters of the Market talk here. I hope to have you on again, maybe in another 6 months. We can see where we're at and what you're buying. $10,000 though on Apple.
Thanks for having me. It was a ton of fun. I'd love to do it again whenever you have me.
Amazing, Jay. Thank you so much. And investors, until the next one, we will see you all there.